Interest rates smash consumer and business sentiment. The government outlined major changes for financial planners in an effort to convince investors to get advice. And Apple's valuation on Wall Street is now larger than the value of all the super funds in Australia. It's Wednesday, the 14th of June, 2023. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael. Looking forward to that Apple story.
That is a cracking stat, that one. Now larger than the value of all the super funds across Australia. It is a monster of a company.
Sure is.
We've got a bit more on that one coming up a bit later on. You've got an interview after the show today, Sean, with Samir Chopra, who is head of research at CBRE.
Yes, so CBRE are a great supporter of ours here at Fear and Greed, and we talk to Samir about what's going to happen in the housing market. Not so much about what has happened, but what's going to happen. And in terms of price rises, he's generally fairly upbeat, particularly in specific segments of the market. Mostly it's because of migration. As he puts it, supply and demand is going to trump interest rates. Well worth a listen.
Oh, yeah, definitely. Really good interview today, Sean. They're all good, of course.
Of course.
But today is definitely worth a listen. The main story this morning, Sean. Interest rate rises are hammering consumer confidence, and even businesses, which until now have been the shining light in the economy, are finding conditions much tougher.
Consumer confidence is stuck at recessionary levels, and the impact of rates was made very clear yesterday. The Westpac Melbourne Institute Consumer Confidence Survey was released. Now, part of it was taken before the rate rise last week and part afterwards. Consumer sentiment had risen from 79 points to 89 points, still low, but 89 points in the days ahead of the Reserve Bank announcement. Then the announcement was made and it tumbled to 72 points. Anything under 100 is considered pessimistic, but the survey just showed how dramatic an impact interest rates are having on confidence. Westpac chief economist Bill Evans said for the last year, the index has held around levels not seen on a sustained basis since the deep recession of the late 1980s, early 1990s. Nearly 8 in 10 respondents said they expect rates to continue to rise over the coming year, with half predicting an increase of 1 percentage point or more. While only a third of households are dealing with the surging mortgage costs, the survey shows inflation more broadly, rather than just interest rates, is a predominant issue on the minds of Australians.
So why... I know I'm inviting an economics lesson here.
Oh, yes, go on.
So why then is consumer confidence so important? Is it all just then tied to spending?
Yeah, totally. It's the idea that if you feel good about your job, about the value of your house, about how things are going generally, you spend more. And so consumer confidence is really fundamental to an economy ticking over. When you are worried about your job, when you are worried about the cost of petrol and how much you've got to pay for energy, you pull back. And we've seen that happening. The retail sales figures have really shown that consumer sentiment is down, so too are retail sales, hence the economy slows.
So those two really go hand in hand.
They do. Well done. You've been listening.
I really have been.
3 years.
Okay, you don't need to point that out. I've already put myself out there and said, I want you to explain this. You just kind of just shove that knife in just a little bit more. What's happening then to business conditions and business confidence?
Well, business conditions continued to ease last month with falls across trading, profitability and employment subcomponents. The National Australia Bank Business Conditions and Sentiment Index shows the fall in conditions is now accelerating. And while they remain a touch above their long-run average, they are well below the levels seen in early 2023, and definitely conditions are on the slide. Now, business confidence fell to -4. It's been below zero since February, i.e. businesses are not confident about the future. But even trading now, that's a conditions index, ain't so good. In trend terms, conditions remain strongest in Western Australia, Queensland and Tasmania. The first two, of course, are big mining states, though they are still positive and at or above average levels in New South Wales, Victoria and South Australia.
All right, business confidence then, Sean. If consumer confidence is about then kind of tied to their spending and the willingness to spend, is that then also the same for business in terms of how much they're willing to invest and just...
Michael, you don't need me anymore.
Well, this is actually the unsubtle way of saying, Sean, we need to have a chat about your position.
That's right.
I'm just auditioning now to take over the top dog role. No, so that's essentially right.
Yeah, that's exactly right. Businesses invest when they're confident about the future. When they're not confident about the future, they pull back, fearing that they're going to have to reduce costs and that type of thing.
Okay. So, well, we've got dreadful consumer sentiment, falling business conditions, and negative business sentiment. Any chance that all of that kind of combined will stop further rate rises?
No. Oh, Michael, please. Nothing like that.
I've been going so well, hadn't I?
No, I mean, it's a fair question. It's unlikely, though, because the Reserve Bank certainly keeps a close watch on both surveys, particularly the NAB Business Survey in recent years. But economists do think that there are another couple of rate rises in coming months, even if they don't think they're needed. And that, of course, is because inflation is still too high.
Sean, I've learnt so much from you. And here endeth the lesson. We now move on to the local share market. How did it perform yesterday?
The S&P ASX 200 finished the day up just a touch to 7,139 points. It was all about the tech stocks, really, following ongoing strength in global tech companies. WiseTech Global and Xero were up 5% and 4% respectively. Domain Holdings and NextDC also did well. Healthcare and telcos did pretty well too. And the travel groups Qantas, Flight Centre and CTM outperformed, CTM being corporate travel management. Energy companies were among the worst performers. Santos and Woodside fell sharply, as did the coal companies. Coal and Whitehaven fell quite a bit. The gold companies dropped, with Newcrest down more than 1.5%, while Rio, Fortescue Metals, Woodside and BHP all ended lower.
And what about international markets?
Well, oil prices remain around 3-month lows following ongoing concerns over the outlook in China and the US. Chinese trade data and figures showing international flights from Northeast Asia are still 40% below pre-virus levels, highlight the weak recovery in the world's top importer of crude oil. Hence, there's downward pressure on oil prices, kind of good for us at the bows up. Gold prices are also lower, and we saw that in the performance of the share prices of Newcrest, etc. yesterday. Coal prices are down, iron ore prices are down, though the Aussie dollar is up a bit. It's trading not that far off 67 US cents.
All right, plenty going on, Sean. We'll be back in a moment with the rest of the day's business news. Sean, the federal government will wind back onerous financial advice red tape, accepting 14 of 22 recommendations made in its year-long quality of advice review.
Michael, in the world of financial advisors, and that's a world we love, this is big news. So, the government is set to abandon a lot of the paperwork for super funds and financial planners in an effort to boost access to affordable advice. But it has stopped short of exempting the big banks from what's known as the best interest duty, which, if they had exempted the banks from that, it would have made it easier for banks to provide advice. The fundamental problem is that not enough of us get financial advice. Alan's partner, Michelle Levy, chaired a review of the rules around financial advice. She handed the government her findings last December. They've been sitting on it till yesterday. One of the key changes will be new legislation to make it cheaper and less risky for super funds to provide advice. So if you're a retiree or you're retiring and you're looking for financial advice, it will be easier for your super fund to give you some. Also, financial advisors will no longer have to provide a lengthy statement of advice document or fee disclosure statements to customers when providing personal advice, and separate fee consent requirements introduced after the Royal Commission will be streamlined. Think about all that. So much paperwork involved, it actually makes it very expensive for a financial planner to provide advice. And the idea with this is to cut some of those costs. The government will also accept Ms. Levy's recommendation to remove the so-called safe harbour steps, which is a legal checklist required to demonstrate a provider has complied with the duty to act in the best interests of clients. In recent years, 10,000 advisors have quit the industry, pushing up the price of receiving advice. Hopefully, making life easier for advisors will encourage more participants in the industry, which will push the price down, and many more people will receive quality financial advice.
Yeah, and that is very good news, Sean. Industry superannuation giant Hostplus is closing its standalone property and infrastructure fund as fears grow that tens of billions of dollars could be wiped out from the commercial property sector as buildings are revalued.
Yeah, so the previous story was really big for financial planners. This one is really big in commercial property. And given most of us actually invest in commercial property via our super funds, it's an important story for everyone. Never sure when you're telling a story, you've got to give people a reason why they should listen before you tell the story, but just park that for the moment.
You've gone all in on this today, haven't you? Every story is going to be kind of introduced with this is why it's important. So keep listening.
That's right. Well, so the background is this. There are plenty of buildings and office towers out there owned mostly by super companies or big investors, but some smaller investors as well, which haven't been adequately revalued since before COVID. Now, eventually that has to happen. And the fear is just like what happened in residential property, prices have actually tumbled. So a building worth $100 million on the books because it was valued 3 or 4 years ago might actually be only worth $85 million. Hostplus said it's closing its standalone property and infrastructure funds for a range of reasons, including concerns around investment risk. That's what I'm talking about. Rebalancing and complexity in unlisted assets. That's all kind of part of that reason what I'm talking about. In short, the fear is, and I can't say Hostplus specifically, but super funds could be sitting on assets worth billions of dollars less than what they've recorded on the books. And of course, that's our money.
That is a big story. Now, Sean, this next story is an important one because it's about politics, and obviously we vote for the politicians, and therefore it's relevant to everyone. I thought I'd just jump in on the trend and try and set the scene. Anyway, we know federal parliament's busy again at the moment with the pollies in Canberra for the next couple of weeks before the midwinter break. Yesterday, the Greens formally rejected a compromise offer by the Albanese government designed to secure the passage of the $10 billion Housing Australia Future Fund.
Under the original policy, the government would invest $10 billion with the Future Fund, and the earnings would be used to build social and affordable housing. Now, responding to criticism from the Greens, who hold the balance of power in the Senate, the government then said it would spend a minimum of $500 million a year with the aim of building 30,000 social and affordable rental homes over 5 years, including 400 properties for women and children facing family and domestic violence, and for older Australians, particularly women, at risk of homelessness. But the Greens said it's not enough. They still want a nationally coordinated freeze on rents and up to $2.5 billion a year on housing. Anthony Albanese, the Prime Minister, he said he's not going to go any further. We're at a stalemate on that one.
Yeah, sounds like it. Also, yesterday we had Labor Senator Katie Gallagher reject the Coalition's allegations that she misled Parliament in 2021 when she said she was unaware of Brittany Higgins' rape allegation before it became public.
Gallagher said she had always acted ethically and with basic human decency on all matters related to Higgins. Former Prime Minister Scott Morrison was also forced to deny he had misled Parliament about what he knew. I think this is just a very sad story all round, Michael. I don't know what the truth of it is, but certainly the media is having a field day on it, and that doesn't help any of the participants in it.
No, it doesn't. One last one on politics, Sean. The latest opinion poll shows that voters have cut their support for Labor from 42 to 40% over the past month, while cooling on the party and Prime Minister Anthony Albanese on key benchmarks, including leadership, vision and competence.
I think they've had such a good run the first 12 months of Parliament or their government. You'd imagine that it has to come off just a little bit. And that shift in sentiment has also delivered a small gain to opposition leader Peter Dutton when voters are asked about their preferred Prime Minister, with his support increasing from 20 to 22%. But according to the Resolve Strategic Survey for the Sydney Morning Herald and The Age, Albanese retains a large lead as preferred Prime Minister, favoured by about 53% of voters. And Michael, just before we leave politics, both Albanese and opposition leader Peter Dutton yesterday said Australians' thoughts and prayers are with the families of those who lost loved ones in this week's dreadful Hunter Valley bus crash.
Yeah, it's terrible. Now, Sean, we've talked a lot in the past about Domino's. In fact, I think CEO Don May has appeared on the podcast before. Yesterday, the share price for Domino's tumbled nearly 10% after it said sales are expected to not meet expectations this financial year.
Yeah, so the share price hit a 4-year low after the pizza chain said underlying earnings have not improved this second half compared to the first half. It's decided it will exit Denmark and cut costs elsewhere. By the end of the day, Domino's share price was about 5% lower, having fallen 10% earlier on. It's down more than 40% since its peak this year, and more than 70% since its COVID peak. The 27 stores in Denmark will close, as will 15 to 20% of its corporate store network. It's got about 900 stores there. What's that mean? About 100, 120 stores will go. The company said about 65 to 70 underperforming sites have been open for some time, but are not expected to reach sustainable levels of sales or profitability. The Domino's story has always been about growth, and suddenly they're closing stores. Investors didn't like that, hence they sold the shares off.
Sean, the Queensland Palaszczuk government has delivered a $12 billion surplus this financial year thanks to coal royalties, but big spending on clean energy projects next financial year will result in a deficit in 2023-24.
Oh, to be the chief accountant in Queensland or Western Australia for that matter. Now, coal royalties in Queensland jumped $10 billion this financial year alone to $15.3 billion, according to the state budget released yesterday. Queensland Treasurer Cameron Dick and Premier Anastasia Palaszczuk also announced a $1.5 billion cost of living package, including $550 energy rebates for all households and up to $1,000 in rebates for vulnerable households. The Treasurer said cost of living measures were a key priority of his fourth budget. While southern states such as Victoria have resorted to big tax increases to cover COVID-19 spending measures, Queensland and Western Australia have benefited from a surge in coal royalties.
Okay, turning to international news now, and China's central bank yesterday surprised most economists by cutting a short-term policy interest rate in an effort to boost the faltering recovery in the world's second largest economy.
This could well flow through to markets in the next few days. The People's Bank of China lowered the 7-day reverse repurchase rate by 10 basis points to 1.9%, according to a statement. It was the first reduction in the rate since August 2022. Now, the move was unusual because it came before the central bank is set to announce any adjustments to the rate on one-year policy loans, known as a medium-term lending facility. That's kind of the benchmark rate. Speculation has grown that the People's Bank of China will cut the rate later this week, just ahead of the release of official data that's expected to show the economy's recovery lost further momentum. Hence, regulators are trying to boost sentiment, at least in the short term.
Sean, Donald Trump has stepped up his rhetoric ahead of his day in court, vowing to extract political revenge for his indictment over mishandling classified documents.
In a social media post, Trump said that if elected to the White House again in 2024, he will appoint his own, quote, real special prosecutor, end quote, to, I quote again, go after, end quote, Joe Biden and his, quote again, crime family.
The quotes just add so much colour to the story.
Incredible. The increasingly tense atmosphere leading into Trump's arraignment in Florida has already raised concerns about protests and violence during his first public rally since his federal indictment was unsealed. Trump over the weekend declared that our people are angry and a final battle is underway to save the country. Well, you can't ever say that he understates it.
Oh, no. You know exactly what he means, and he knows how to get a headline.
Yeah, and we're giving it to him.
Oh, absolutely. Now, Sean, the story that we mentioned at the top of the show, I've been waiting for this one. Apple shares hit their first all-time high in more than a year yesterday, demonstrating just how important big tech is to the current rally on Wall Street.
We talked about this in Monday's show, but it's worth having a look at Apple specifically. It's now worth $2.9 trillion US dollars, and it accounts for 7% of the whole S&P 500. The S&P 500, or the US market, is about 40% of global equities. So if you do the maths there, I think that's 2.8% of all global equities is Apple. It's quite remarkable. Its share price is up more than 40% this year. Now, the cause of the most recent surge is the launch of its Vision Pro mixed reality headset last week. The stock, though, is a favourite no matter what economic circumstance. It's viewed as a safe haven amid turmoil in the banking sector earlier this year, for example, while its recent results have topped expectations and eased concerns about its growth prospects. The value of Apple is worth more than the value of the superannuation industry in Australia combined. If you add in Microsoft and Alphabet, the parent of Google, those three combined value is more than the value of all the residential homes across Australia. Remarkable.
Everything about that story is extraordinary.
And Michael, we do have a weekend edition. I've got my hand up for the most remarkable story. That's it.
Oh, that's not fair.
I just got in first because you would have if you'd thought of it.
Okay, anyone who's listened to the weekend edition at any point in recent weeks knows how much I am the underdog in what is a ferocious competition between the two of us. And Sean, every week you just keep pummeling me. And this week I thought, you know what? I'm going to use this Apple story. I reckon it's what I need. And what did you do? You pummeled me again.
Yeah, no, I don't buy any of that. You just made that up on the spot.
Okay, maybe a little bit. Sean, up next is the Fear and Greed Daily Interview. You are speaking today with Samir Chopra, Head of Research at CBRE, which is a supporter of this podcast.
Yes, all about what's going to happen in the housing market. Good news, I think, if you own a house in inner city, particularly apartments in Sydney, Melbourne, Brisbane, perhaps not if you're trying to get into that market.
Yeah, it's definitely worth a listen. It's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. And Sean, there's a new episode today, being Wednesday, of course, of How Do They Afford That? Our sister podcast.
What's it about?
Today, it's actually all about cars, and it's about car loans and it's about car leases and just kind of going through what you need to be thinking about before you kind of dive in. And perhaps get one of those, because really cars are one of those topics that you do look at someone else's car and you ask that question, how do they afford that? And chances are they're not actually buying it outright. They might have it on finance, or they might have a lease agreement through their workplace. And we just explore basically how they work and how you could potentially use one of those too. I personally think it's well worth a listen.
I'm sure it is. Now, just before we go, can I just jump in? I got a message on LinkedIn from Jack. And I got to read it to you, Michael. Hi, Sean. My name is Jack, and I'm a 23-year-old science nerd who listens to the Fear and Greed podcast every day on the bus to university. I just wanted to thank you and Michael for brightening my mornings with your sort of witty puns and fantastic updates on all things business. All the best, Jack. Oh, he gets our Mia Award for the day.
That's amazing. Jack, 23-year-old science nerd. He should be listening to the weekend edition, because I bust out some great kind of science and space stories and things like that.
I love the way he goes with your bracket, sort of, end bracket, witty puns.
Yeah, I was trying to gloss over that part. And then he was full of praise for the part that you contribute, which is the business.
And fantastic. Oh, you're right. Go, Jack.
Yeah, good one, Jack. Thank you very much for listening. And thank you, Sean.
Thank you, Michael.
It's Wednesday, the 14th of June, 2023. Make sure you're following the podcast and join us online on LinkedIn, Instagram, Twitter, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.